Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about AIR LEASE CORP quarterly report. AIR LEASE Corporation offers a diverse range of services to the aviation industry. The company's primary business includes aircraft leasing to airlines, worldwide sale of commercial jet aircraft to third-party investors, fleet management services for aircraft owners and investors, purchase and leasing of commercial jet aircraft from manufacturers. These services cater to various clients, including airlines, leasing companies, financial institutions, and individual investors. The significant increase in AIR LEASE Corporation's stock price over the past year can be attributed to several key factors. The company's strong Q3 2025 earnings and revenue growth, driven by a 9% increase in total rental of flight equipment revenue, have contributed to its success. Additionally, the recovery from the Russian fleet write-off has provided a $60 million benefit, with AIR LEASE recovering 104% of its initial loss. The approved buyout offer from Sumisho AIR LEASE Corporation for $7.4 billion is also expected to boost investor confidence and create the world's largest aircraft leasing firm after AerCap. Furthermore, robust demand for leased aircraft due to production delays at major manufacturers has led to higher lease rates for lessors like AIR LEASE. The company's commitment to growth and modernization through its fleet expansion and modernization efforts, with 228 new aircraft currently on order, has also contributed to its success. Overall, these factors have combined to drive AIR LEASE Corporation's stock price up by over 43.94% in the past year. The primary drivers of revenue growth or decline can be summarized into three key areas. On the growth side, lease rentals and depreciation expense increased due to fleet expansion, while gains from aircraft sales and trading, as well as management fee revenue, contributed significantly to revenue growth. On the decline side, maintenance rentals and other receipts decreased primarily due to lower collections and end-of-lease revenues. Additionally, gains from aircraft sales and trading declined mainly due to reduced sales volume. These factors highlight the importance of fleet management, sales performance, and lease incentives in driving revenue growth or decline. Net income and profit margins overview. The company's net income has experienced significant growth, with a 41% increase in the 3 months ended 2025 compared to the same period in 2024. This trend continued into the 9 months ended 2025, with a staggering 188% increase year-over-year. The net income margin for the 3 months ended 2025 improved from 10% in Q3 2024 to 12.6%, while the adjusted pre-tax margin increased by 34%. However, profit margins have not consistently improved across all periods. The 9 months ended 2025 saw a decrease of 0.4% in adjusted pre-tax margin compared to the same period in 2024. Additionally, the net income margin for Q3 2025 decreased from 15.7% in 2024 to 14.9%. The reasons behind these changes are largely attributed to external factors, including an increased composite interest rate on floating rate debt and unhedged foreign currency investments. These factors have likely contributed to the fluctuations in profit margins, highlighting the importance of managing risk and adapting to changing market conditions. The company is indeed generating positive operating cash flow, as evident from the financial summary and supporting data on pages 11 and 42 of the report. The net cash provided by operating activities has consistently increased over the years, with a notable jump in 2024 to $1,320,553. This significant increase demonstrates the company's ability to generate substantial positive cash flow from its core operations, indicating a strong financial health. The company's debt level and interest expenses have undergone significant changes in recent periods. Notably, the total debt financing has decreased slightly from $20,389,907 to $20,340,227. However, this decrease is overshadowed by a substantial increase in interest expenses. Interest expenses have risen by 4.6% from $217.5 million to $228.4 million, primarily due to an interest rate rise of approximately $49.3 million. The composite cost of funds has also increased from 4.14% to 4.29%, contributing to the higher interest expenses. Additionally, the revolving credit facility's interest rate has changed, and a new Tranche B commitment with a margin of 1.05% per year has been added. While interest payments on debt have increased, the company recorded a net benefit from the settlement of insurance claims, partially offsetting the higher interest expense. Overall, the changes indicate that the company's financial situation is becoming more expensive due to rising interest rates and increasing debt costs. The company's financial performance varied across different regions and segments. The Asia-Pacific region and Europe showed strong growth, with the former experiencing a 7% year-to-date increase. In contrast, North America struggled with modest growth, while domestic traffic growth was slower than expected. China also underperformed, accounting for only 1.6% of the company's leased aircraft. Additionally, the U.S. domestic market saw a mere 2% year-to-date growth, indicating a sluggish performance in this key market. Management is optimistic about the company's outlook, citing favorable market conditions due to population growth, air travel demand, and global economic health. They aim to maintain a strong lease utilization rate by growing their fleet and raising unsecured debt in global bank and investment-grade capital markets. The company expects to continue benefiting from strong demand for aircraft and increasing lease rates, with a moderate upward trajectory in lease yield expected through 2029. Management also plans to invest in modern aircraft, maintain an investment-grade balance sheet, and return excess cash to shareholders through regular quarterly dividends. The company's financial summary reveals a clear indication that it has indeed paid dividends to its shareholders. Specifically, from page 12 and page 45, it is confirmed that the company has distributed dividends on both common and preferred stock. However, there is no mention or evidence suggesting that the company has engaged in share buybacks. Concerns about inventory buildup or supply chain disruption exist. There are valid concerns regarding inventory buildup or supply chain disruption in the aviation industry. Manufacturing delays have impacted planned purchases of aircraft from Airbus and Boeing, leading to potential delivery delays beyond revised contractual dates. The FAA's production cap on Boeing's 737 MAX has further exacerbated these issues. Airbus and Boeing are experiencing ongoing delivery delays due to various factors such as engine manufacturer delays, shorter on-wing engine time, supply chain challenges, and the FAA's involvement in Boeing's production rates. These disruptions have significant implications for the industry, highlighting the need for careful management of inventory levels and supply chains to mitigate potential risks. And that concludes the financial summary for Air Lease Corp. Feel free to comment below, and I will be happy to answer them when possible.